Imagine losing money in the stock market, which happens to the best of us, and then on top of that, paying more in taxes than you need to. Sounds frustrating, right? Many investors unknowingly leave thousands of dollars on the table every single year because they don't understand, or worse, misapply a crucial financial strategy. This isn't about shady loopholes. It's about smart, legal tax planning that can make a real difference to your bottom line. Stick with us, and by the end of this video, you'll know exactly how to avoid these costly errors and turn investment losses into tax wins. Today, we are pulling back the curtain on one of the most powerful, yet often misunderstood, strategies in an investor's toolkit: tax loss harvesting. This isn't just for the ultra-rich. It's a tool every investor, from beginners to seasoned pros, can and should use to optimize their portfolio and reduce their tax burden. We'll uncover surprising facts, tackle common myths head-on, and give you concrete examples that make these abstract financial ideas crystal clear. Get ready for an aha moment that could change how you approach your investments forever. So, what exactly is tax loss harvesting? In its simplest form, it's the practice of selling investments at a loss to offset capital gains and, potentially, a limited amount of ordinary income. Think of it as finding a silver lining in a down market. When an investment you own has dropped in value, instead of just waiting for it to recover, you can sell it, realize that loss, and then use that loss to reduce other taxable income. It's a perfectly legal and smart way to minimize what you owe Uncle Sam. Let's break down the basic mechanics. When you sell an investment for a profit, you owe capital gains tax. When you sell an investment for a loss, you can use that loss to cancel out some of your capital gains. This reduces the amount of gains you're taxed on. If your losses exceed your gains, you can even use up to $3,000 of those losses each year to reduce your ordinary income, like your salary. Any remaining losses can be carried forward to future tax years, indefinitely. It's like building a bank of future tax breaks. Let's meet Sarah. She's a young professional, enthusiastic about investing, and just dipped her toes into the stock market a year ago. She bought a few tech stocks, some did well, others, not so much. She has some nice gains, but also one stock, Gizmo Tech, that's down significantly. She's heard whispers about tax loss harvesting, but isn't sure what it is or if it even applies to her modest portfolio. This is where many investors, just like Sarah, make their first big mistake, simply ignoring the strategy altogether. Sarah's first mistake is a common one. She's not actively looking for tax loss harvesting opportunities. She sees her Gizmo Tech stock is down, feels a bit disappointed, and just holds onto it, hoping it will recover. What she doesn't realize is that even if she holds onto it, she could have sold it, claimed the loss, and then immediately reinvested in a similar, but not substantially identical, stock or ETF. She's missing out on a significant tax break that could have offset her gains from other successful investments. Let's get more specific about the impact. If your total capital losses for the year exceed your total capital gains, you can use up to $3,000 of those net losses to reduce your ordinary income. This is a direct reduction of your taxable income, dollar for dollar. For someone in a 22% tax bracket, a $3,000 reduction in ordinary income means saving $660 in taxes. That's real money that stays in your pocket, not sent to the IRS. Ignoring this rule is like refusing a gift from the tax gods. What if your losses are greater than $3,000 and you don't have enough capital gains to offset? No problem. The remaining losses don't disappear. They can be carried forward indefinitely to offset future capital gains or up to $3,000 of ordinary income in subsequent years. This means you're building a valuable asset, a loss bank that can shield future profits from taxes. This long-term benefit is a key reason why overlooking tax loss harvesting, even in years with no immediate gains, is a significant oversight. Let's go back to Sarah. She had a $5,000 loss in Gizmo Tech and a $7,000 gain in another stock. If she had harvested her loss, she could have used the $5,000 loss to offset $5,000 of her $7,000 gain, reducing her taxable gain to just $2,000. This could save her hundreds, if not thousands, depending on her tax bracket. But because she didn't act, she'll pay capital gains tax on the full $7,000. This simple inaction demonstrates how many investors lose out on thousands each year by not understanding or misapplying TLH. Now, let's tackle one of the biggest myths. Tax loss harvesting is too complicated for me. We hear this all the time. People assume it involves complex calculations or requires a financial degree. While there are rules to follow, the core concept is quite straightforward, and modern brokerage platforms often simplify the process. The biggest hurdle is usually just understanding the basic rules, which we are covering right now. Don't let perceived complexity deter you from a valuable tax-saving strategy. To really understand gains and losses, you need to grasp cost basis. This is simply the original value of an asset for tax purposes, usually what you paid for it, including commissions. When you sell an investment, you subtract its cost basis from the selling price to determine your gain or loss. If you bought shares at different times or prices, your broker usually tracks this for you. Knowing your cost basis accurately is fundamental to calculating your gains and losses correctly, which is the first step in tax loss harvesting. Let's do a quick example. If you bought 100 shares of a company for $50 each, your cost basis is $5,000. If you later sell those 100 shares for $40 each, you receive $4,000. Your loss is $5,000, cost basis, minus $4,000, selling price, which equals a $1,000 capital loss. If you sold them for $60 each, you'd have a $1,000 capital gain. It's that simple. Without accurately tracking your cost basis, you can't tell if you have a taxable gain or a harvestable loss. Here's where many investors stumble and make a costly mistake, violating the wash sale rule. This rule is designed to prevent investors from claiming a tax loss while still essentially maintaining their investment position. The IRS doesn't want you selling a stock at a loss on Monday and buying it right back on Tuesday, just to claim a tax break. So, they created a specific restriction. Understanding this rule is absolutely critical to successfully implementing tax loss harvesting. Let's introduce David, a seasoned but busy investor. He had a $4,000 loss on shares of Global Widgets and decided to harvest that loss at the end of the year. Smart move. However, he liked the company's long-term prospects, so he bought back the exact same shares just 2 weeks later. Unfortunately for David, because he bought substantially identical stock within 30 days before or after the sale, his $4,000 loss is disallowed by the IRS. It's as if he never sold it for tax purposes, negating his entire effort. The wash sale rule states you cannot buy a substantially identical security within 30 days before or after the sale that triggered the loss. But what does substantially identical mean? For most common stocks, it means the exact same stock. For bonds, it's more nuanced, referring to things like interest rate, maturity, and issuer. For ETFs, it generally means an ETF that tracks the same index or sector. The key is to replace the sold security with something similar enough to maintain your market exposure, but different enough to avoid the wash sale trap. Avoiding the wash sale rule is simpler than it sounds. If you sell a stock at a loss, you have two main options. 1. Wait at least 31 days before buying back that exact same security. 2. Immediately reinvest the proceeds into a different security that has similar investment characteristics but is not substantially identical. For example, if you sell an S&P 500 index ETF at a loss, you could buy a total stock market ETF or another S&P 500 ETF from a different provider. This lets you maintain your market exposure while respecting the IRS rules. Another critical distinction often overlooked is the holding period of your investments. This determines if your gains or losses are short-term or long-term. Short-term means you held the investment for 1 year or less. Long-term means you held it for more than 1 year. Why does this matter? Because capital losses must first offset capital gains of the same type. Short-term losses offset short-term gains, and long-term losses offset long-term gains. Meet Elena, who's planning for retirement and has a diversified portfolio. She harvested a significant short-term loss but also had a large long-term gain. She assumed her short-term loss would wipe out her long-term gain dollar for dollar. This is mistake number 3, ignoring holding periods. Short-term losses are more powerful because they first offset short-term gains, which are taxed at higher ordinary income rates. If Elena had instead harvested a long-term loss, it would first offset her long-term gain, which is taxed at lower rates. The order matters for optimal tax savings. Let's clarify the netting rules. First, short-term losses offset short-term gains. Then, long-term losses offset long-term gains. If there are any remaining losses, they then offset the other type of gain. For example, excess short-term losses can offset long-term gains, and vice versa. After all gains are offset, if there's still a net capital loss, you can use up to $3,000 against your ordinary income. Any remainder carries forward. This specific order is crucial for maximizing your tax benefits. Considering Elena's situation, if she had a $10,000 short-term loss and a $5,000 long-term gain, the $10,000 short-term loss would first completely wipe out her $5,000 long-term gain. She would then have a $5,000 net short-term loss remaining. Of this, $3,000 could offset her ordinary income, and the final $2,000 would carry forward. This specific netting order allowed her to effectively eliminate her long-term gain and get a significant ordinary income reduction. Knowing these rules ensures you get the most bang for your buck from every loss. Here's a truly surprising fact. Many investors lose out on thousands, sometimes tens of thousands, each year by not understanding or misapplying tax loss harvesting. It's not just a minor oversight, it's a significant drain on their investment returns. Think about it. Every dollar you save in taxes is a dollar that stays invested and can continue to grow. Over years, these missed opportunities compound, creating a substantial difference in wealth accumulation. This isn't just theory, it's tangible money being left on the table. Another pervasive myth is that tax loss harvesting is only for the super rich. This couldn't be further from the truth. While high net worth individuals often use it due to larger portfolios, the benefits apply to anyone with taxable investment accounts. If you have any capital gains or ordinary income, and you have some investments trading below their purchase price, you can benefit. Even a few $100s in tax savings can be significant, especially for those just starting out or managing smaller portfolios. It's a strategy for everyone. While we've mostly talked about stocks, tax loss harvesting isn't limited to individual equities. You can also harvest losses from exchange-traded funds, ETFs, mutual funds, and even bonds. The rules generally apply the same way, though substantially identical can be more complex for bonds due to their unique characteristics. The key takeaway is to look across your entire taxable investment portfolio for opportunities, not just your favorite stocks. Every asset type has the potential for a tax-saving harvest. Another mistake is underestimating the importance of accurate record keeping. When you sell a security, your brokerage firm will provide a Form 1099-B, which reports your sales proceeds and cost basis to the IRS. However, it's ultimately your responsibility to ensure these records are correct and to apply the wash sale rules accurately. Poor record keeping can lead to miscalculating losses, violating the wash sale rule without realizing it, and potentially facing IRS penalties. Don't let disorganized paperwork turn a smart strategy into a headache. Today, many brokerage platforms and robo-advisors offer automated tax loss harvesting services. This is a game changer for busy investors. These tools can automatically identify losses in your portfolio and execute trades to harvest them, all while adhering to the wash sale rule. This convenience can dramatically increase the consistency and effectiveness of your tax loss harvesting efforts. However, don't assume the software is infallible or that you no longer need to understand the rules yourself. Automation is a tool, not a replacement for knowledge. Here's a subtle but critical mistake: blindly trusting automated software without understanding the underlying rules. While excellent, these tools can have limitations. For instance, they might not track all your accounts if you have investments at multiple brokerages, which could inadvertently lead to a wash sale violation if you buy the substantially identical security elsewhere. Or they might make assumptions that don't perfectly align with your specific tax situation. Always review what the software is doing and ensure it aligns with your strategy. Knowledge is your best defense. Here's the aha moment we promised. Tax loss harvesting isn't just a year-end scramble, it's a proactive, ongoing strategy. Instead of waiting until December 31st, smart investors look for opportunities throughout the year. Markets fluctuate daily, creating potential losses at any time. By regularly reviewing your portfolio, perhaps quarterly or even monthly, you can capture losses as they occur. This turns market volatility into a strategic advantage, allowing you to continually optimize your tax situation rather than just reacting once a year. While powerful, tax loss harvesting isn't always the right move. If you believe a losing investment still has strong long-term potential, Selling it just for a tax loss might not be ideal if you don't have a suitable replacement or prefer to maintain that specific position. Also, if you're already in a very low tax bracket and have few capital gains, the immediate tax benefits might be minimal, though building a loss carry forward is still valuable. Always consider your overall investment goals and tax situation before making any trades. A very common mistake is waiting until the last minute of the year to consider tax loss harvesting. This year-end rush can lead to hasty decisions, overlooked opportunities, or even accidental wash sale violations. Brokers might have cutoff times for trades to settle by year-end, and if you miss them, your loss won't count for the current tax year. Procrastination is the enemy of effective tax planning. Make it a habit to check your portfolio well before December 31st, giving yourself ample time to act thoughtfully. Instead of a one-time event, view tax loss harvesting as an ongoing component of your investment strategy. Just as you regularly rebalance your portfolio or review your asset allocation, make time to assess your gains and losses. This isn't about market timing, it's about tax timing. By integrating this practice, you can systematically reduce your tax liability over time, freeing up more capital to reinvest and further accelerate your wealth accumulation. It's about smart money management, not just lucky trades. Remember the concept of carrying forward losses? This is an incredibly powerful, long-term benefit. Even if you don't have enough gains or ordinary income to fully utilize your losses in the current year, those losses don't vanish. They become part of your personal loss bank, ready to offset future gains. Imagine a scenario where you have a massive capital gain from a highly successful investment in 5 years. Your carried forward losses can significantly reduce or even eliminate the tax bill on that big win. That's true financial foresight. So, how do you start? Practical step 1. Regularly review your investment portfolio. Most online brokerages provide tools that show your unrealized gains and losses. Take a look at your positions that are currently in the red. Identify which ones you're comfortable selling, keeping in mind your long-term investment strategy. Don't just focus on the big losers. Even smaller losses can add up, especially if you have numerous positions. Make this a quarterly or even monthly habit, not just an annual chore. Once you've identified potential losers, consider their holding period. Are they short-term or long-term losses? This will influence how they interact with your gains. Then, evaluate if you want to exit that position permanently, or if you want to maintain similar market exposure by buying a substitute security. If you choose a substitute, make sure it's genuinely not substantially identical to avoid the wash sale rule. This step requires a bit of thought but can lead to significant tax savings. Leverage your brokerage's tools. Most major brokerages offer reporting that can help you track your cost basis, realize gains and losses, and even warn you about potential wash sale violations. Some even have dedicated tax loss harvesting features. Get familiar with these resources. They are designed to simplify the process and help you stay compliant. If you're unsure, don't hesitate to reach out to your broker's customer support for guidance on how to best use their platform for tax loss harvesting. If your financial situation is complex, or if you simply prefer professional guidance, don't hesitate to consult a qualified financial advisor or tax professional. They can provide personalized advice, help you understand the nuances of the rules, and ensure your tax loss harvesting strategy aligns perfectly with your broader financial plan. While DIY is possible, a professional can provide peace of mind and help you avoid costly mistakes, ensuring you're maximizing every tax-saving opportunity. Let's recap the incredible benefits of correctly applying tax loss harvesting. You can offset capital gains, reducing your current tax bill. You can reduce your ordinary income by up to $3,000 annually. You can build a loss bank that carries forward indefinitely, shielding future gains. And you can turn negative investment performance into a tangible tax advantage. This strategy isn't about avoiding taxes. It's about optimizing your tax efficiency and making the most out of every investment decision you make. The biggest mistake you can make with tax loss harvesting is doing nothing, or doing it incorrectly due to misunderstanding the rules. By taking the time to learn and apply this strategy, you're not just saving money, you're taking greater control over your financial future. You're transforming potential setbacks into opportunities, making your money work smarter for you. Don't let fear of complexity or common myths hold you back. Empower yourself with this knowledge and watch your tax efficiency improve. We hope this deep dive into tax loss harvesting has given you the clarity and confidence to apply this powerful strategy effectively. Now, it's your turn to put this knowledge into action. Review your portfolio, understand your cost basis, and keep that wash sale rule firmly in mind. If you found this video helpful, please give it a thumbs up, share it with a friend who might benefit, and subscribe for more essential financial insights. What other tax strategies would you like us to cover? Let us know in the comments below.